Hi everyone, this is our CFA final project that we did on Chevron Corporation. It will be presented by myself, Claire Forrest, Jake Biesterfeld, Hoyt Bright, and Brendan Borovansky. Chevron Corporation, also known as Chevron or by their ticker symbol CVX, is an American multinational integrated energy corporation. Chevron engages in all aspects of the oil and gas industries and refines, markets, and transports chemical, manufacturing, and power sales and generation. Chevron's current stock price is listed as $86.50 as of April 23rd, 2020 at 7:58 p.m. Eastern Time. We currently do not recommend a buy in Chevron at the current time. Due to the pandemic that is COVID-19, the company's stock has experienced a record low of $54.22. The economic fallout that was created by the pandemic has caused companies like Chevron to be hit the hardest. Oil prices have drastically decreased to the point where they turned negative on April 20th, 2020, and storage capacity globally has shriveled. With far less demand for oil and gas, the price for barrel oils will continue to decrease due to the shelter-in-place being enforced in cities all over the nation. With less air transportation, motor vehicles, and hydrocarbon gas production, the usefulness for oil and gas continues to decline. Chevron's one-year target price is $116.11. We do not recommend that you buy stock in Chevron. Chevron Corporation is a reputable integrated energy company that engages in energy and chemical operations. Founded in 1906, Chevron works through the upstream and downstream segments while participating in financial management, administrative, and technology support. Chevron also produces and transports major oils and natural gases and engages in refining, marketing, and the distribution of fuels.
Industry overview and competitive positioning. Chevron currently holds a market share of approximately 3.39% and hopes to increase its market share by investing in alternative energy sources and increasing its upstream business in the next few years. As oil prices continue to either plateau or decrease, the advancements of alternative energy from other companies is Chevron's biggest threat. The fortified forces of Chevron are threats of new entrants, threats for substitute products, bargaining power of suppliers, bargaining power of buyers, and rivalry amongst existing players. Threats of new entrants in the large integrated oil and gas industry bring innovation, new ways of doing things, and pressure on other companies by reducing their price strategies, reducing costs, and providing customers with new value positions. The need to bring new entrants in a dynamic industry with well-established players such as Chevron is low due to its reduced windows of profit. The threat of substitute products in the industry is high due to the advancements of renewable energy, new products and services. The need to become service-oriented as well as product-oriented is important to existing customers. The threat of bargaining power of suppliers is fairly high due to the powerful suppliers in the material sector's ability to have a dominant position in the market to decrease the margins that a corporation can earn in the market. Chevron's biggest threat is that their supply chain is cut off or product design is reduced. These products provide a variety of different materials that they can use as insurance. The threat of bargaining powers of the buyers is high in the industry. They want to be able to buy the best offerings available, and this idea causes competing corporations to go head-to-head with each other over a price battle. The need to innovate new products that are unique to the market is essential to controlling prices and preventing existing customers from defecting to other companies. The competition of existing players in the industry is high due to how competitive the market is with other existing firms. The biggest threat to Chevron is competitors decreasing their prices and profitability of products in the industry. There is also a lack of product differentiation, so the need to collaborate with other competitors to increase their market size instead of competing for a small market. The SWOT analysis of Chevron is broken up to 4 parts: its strengths, opportunities, weaknesses, and threats. The strengths of Chevron is its brand value, which is $17.88 billion and is the 5th largest oil company in the world. It also has a complete integration of producing, refining, and selling products, creating a very efficient value chain. Furthermore, Chevron has a very diverse portfolio of products while holding a strong global presence spanning more than 180 countries. Chevron's weaknesses is that it has increased debt with a total debt and capital lease of $27 billion while also having about 1.9 billion shares outstanding. Chevron has also been dealing with a large number of legal issues and illegal acts. The company has been fined by the EPA before for breaking federal guidelines of emissions and is expected to continue to have other legal issues in the future. Chevron's opportunities in the future is its investments in the renewable energy market, which it has already invested and built renewable energy facilities in California, New Mexico, and Wyoming. It also has made long-term deals with companies such as China's Hurrian Green Energy Company to provide strong foundation for the future of Chevron. Chevron's biggest threats are regulations from the government and economic crisis that may cause oil prices to fall and reduce potential profits. Instability of the market can cause countries to cut a great deal of their oil imports, with falling oil prices in the market cutting into Chevron's profits. Also, natural disasters can add extra expenses and cut into Chevron's profits. Disasters such as earthquakes, hurricanes, and etc. can damage pipelines and oil rigs.
At this point in time, it is not recommended that anyone should invest in companies like Chevron. Before the global pandemic, that is COVID-19, occurred, the company's stock sold for around $115 per share. Since then, it has experienced a record low of $54.22. With that economic fallout that was created by the pandemic, companies like Chevron were hit the hardest. Oil prices have drastically decreased, so much so that they turned negative on April 20th, 2020, and storage capacity globally has shriveled. With far less demand for oil and gas, the price for barrels of oil will continue to decrease. Right now, companies like Chevron are having to pay traders to take oil off their hands. The reason why COVID-19 has impacted the price of oil is because of how many people are staying stationary in their homes. With less air transportation, motor vehicle transportation, and hydrocarbon gas production, the usefulness for oil and gas continue to decline. However, it is important to note that this is a stock to keep an eye on once this pandemic passes. There will be massive demand for crude oil again. Chevron has positioned themselves in such a way that they have a large global presence. They have complete integration within their product. That is, Chevron has their own production, refinement, and distribution of oil and gasoline.
Financial analysis. Over the past year, Chevron has struggled with following its business plan, but has made strides to reduce its debt. The return on capital has been 0.44%, a net margin of 2%, and a debt-to-equity ratio of 22%. While this ratio may seem high, it will be considered safe as long as Chevron doesn't take on too much debt obligation, which will limit the amount of growth. Amidst the global COVID-19 pandemic, Chevron has recently decided to cut its capital budget by $4 billion, as well as its 2020 spending by 20%, or roughly $16 billion. This decision was brought by a combination of the virus, crashing demand for oil, as well as an increase in the oil supply brought by Saudi Arabia and Russia's oil price war. What this means for Chevron is the flattening of oil production and an increase in layoffs to come. Dividends of Chevron, however, will still be protected, but Chevron will suspend stock buybacks. Cash flows will no doubt decline as they have in accordance with recent events. However, this could worsen in the future if the demand for oil does not rebound. As it stands, free cash flow is $13,198 million, while higher than years prior is less than 2018. Which was $16,826 million. While not especially concerning, it is most likely due to increased expenses. Furthermore, cash flow from operational activities is $27,314 million, while total debt is $26,973 million, which was lower than the year prior. In the efforts to reduce expenses recently, Chevron has been successful. Due to the recent virus, expenses as well as cash flow will likely experience a large decrease due to the massive cut in capital. For future performance, the overall demand for oil is dependent on the economy's ability to rebound. With the demand for alternative and renewable energy in high demand over the next 30 years, Chevron will have to invest in alternative energy and whether or not President Trump is able to rebound the economy. Valuation. we averaged the two-stage discount model and the comparables model to arrive at our target price of $79.99, indicating an increase of 4% from Chevron's initial stock price of $77.20. Unfortunately, we had to opt for the annual report instead of a recent one due to the lack of information. The potential drawback to utilizing old information is that the valuations can yield overly optimistic numbers. First is the two-stage discount model. As you can see by the table, we calculated the average growth of Chevron's dividend by using its numbers from the last 5 years. This yields an average of 27.21%. In the next two tables, we used our growth average to produce forecasted dividends for the next 5 years. Using our dividends, the discount rate, and cash flows, we were able to arrive at our stock valuation at $77.43. It should, however, be noted that the dividend growth is positively skewed due to the large increase in the past 3 years. In addition, the dividend will likely decrease due to the recent drop in stock from the virus. The next model we used is the comparables model. Comparable companies were determined by large companies in the gas and oil industry that exhibited similar qualities to Chevron. The companies included are Chevron, ExxonMobil, and Valero Energy, all direct competitors with each other. To find our numbers, we used a combination of each of the company's most recent 10K reports, as well as quotes from the Wall Street Journal. We then calculated the forward price over equity ratios and forward earning per share ratios for each of the respective companies, assuming the same number of outstanding shares as the year prior. Finally, we averaged each of the company's price per share to find the expected average share price for Chevron at $82.55.
The first investment risk is market risk. With the current market crash due to the global pandemic, oil companies are taking a huge hit and loss. Chevron is no exception, and this makes it a huge risk for investment at the current time. Market fluctuations and a change in economic conditions are unavoidable, but the COVID-19 pandemic is forcing Chevron to take a significant profit loss. The next risk is physical risk. Oil spills and other miscellaneous accidents can occur with the production dealing with oil, gases, and chemicals, and could result in major profit loss for the company. Oil spills can make the company's share prices fall drastically. Chevron also faces credit risk. Chevron is not in control of third parties that could owe their company large sums of money or assets. Another risk is legal risks. Large oil corporations are often faced with legal risks. Oil is often imported from foreign countries, and changes in these regulations could cause legal risks. Next is operational risks. Despite training and supervision of employees and workers, human error is still a risk in any investment. Transactions can be recorded wrong or improperly evaluated. Another risk that many companies find themselves facing is technology risks. Chevron is at risk to hackers breaking into their security. Dividend cuts are another risk that Chevron may take. Dividends, although desirable at first, can create a huge risk if Chevron is not able to earn enough profit to pay investors, which could ultimately lead to a cut. This is especially prevalent in the current time with the global pandemic, as Chevron is not making as much profit as they normally would. Due to all of these risks that we have mentioned, we do not recommend a buy in Chevron stock at the current point in time.
Chevron's current CEO is Michael K. Wirth. Prior to being elected, he served as the vice chairman to the board of directors for 3 years before being elected as the CEO. Ronald D. Sugar is a lead director and is also on the board of directors for companies such as Apple, Uber, Amgen Incorporation, and Air Lease Corporation. He currently occupies the chair of board nomination and compensation. Wanda M. Austin is the director for public policy. She has been a director since 2016 and was a former CEO and president of the Aerospace Corporation. John B. Frank has been on the board since 2017 and is the audit committee financial expert. He is also the vice chairman of Oak Tree Capital Management. Alice P. Gast, president, Imperial College, Enrique Hernandez Jr., CEO of Intercon, Charles W. Mormon IV, former president of Amtrak, and Dembisa F. Moyle also reside on the board of directors for Chevron. Corporate governance can also be scored with the ISS Quality Score. This is a data-driven scoring module that helps investors in financial analysis alike quickly assess the amount of risk associated with various companies. The score is broken down into 4 different components: board structure, compensation, shareholder rights, and audit and risk oversight. A score of 1 indicates virtually no risk, while a score of 10 indicates high risk. Chevron's board structure scored a 7, medium to high risk. Compensation scored a 5, medium risk. Shareholder rights scored a 1, which is very low risk, and audit and risk oversight was also scored with a 1, which is virtually no risk. Chevron's overall ISS quality score was 2. This indicates that Chevron poses a low governance risk.